So, hello everyone. My name is Hershey Kaur, and this is my final time series project for ADM 3628. For my data set, I chose the Hershey's company, and I worked with daily price data from 2018 all the way to the end of 2025. In this presentation, I'll walk you through how I analyzed the data, checked whether the series was stationary, built a model, tested it, and then used it to forecast the dataset price into 2026. And I also talk about what these results actually mean in a financial sense. So let me start with the dataset first. This is the daily closing price of HSY from January 2018 to late 2024. I also used all of 2025 as a testing year. One thing I liked about this data is that it came in really clean, no missing values. I checked all the outliers by looking at returns, and the few big moves in the data were all real events like earnings, announcements, or market news. So I kept like everything. Looking at the chart, you can see a very obvious trend. HSY climbed pretty strongly from 2018 up to around mid 2023. That period is basically uninterrupted growth. Then the stock peaks and starts to fall and then become more volatile in 2023 and 2024. In 2025, it's much more sideways and uncertain, as we can see. This change in behavior is important because models need to handle both the strong growth years and the more volatile years. Before modeling anything, I had to check whether the price series is stationary. Most stock prices are not, and HSY is no different. So these two plots, the ACF and PACF of the raw price, make it really clear. The order correction stays extremely high across all lags. That basically tells us the price has a persistent trend and doesn't settle around a stable mean. Same idea with the PACF. The first few bars are extremely high. So the raw price is definitely non-stationary, which means I cannot model it directly. I need to transform it first. So for to fix the non-stationary, I converted prices into log returns. This is super common in finance because returns behave a lot better statistically. Once I did that, the ACF and PACF changed completely. Instead of everything being highly correlated, now almost everything drops to zero right away. Only the first couple of lags matter. This tells me that log returns are stationary and they're suitable for ARIMA or ARIMA model. The ADF test also confirmed the same thing. So after this point, everything I model is based on returns, not the raw price. So after model fitting the ARIMA model, after fitting an ARIMA model to the returns, basically, I ran diagnostics to make sure the model actually fits well and isn't leaving any patterns behind. The big figure summarizes everything. The top left plot shows us the residuals over time. They bounce around zero with no trend and no structure. The ACF and PACF of the residuals are basically flat, so the model removed autocorrelation. And the QQ plot on the bottom right checks whether the residual looks normal um, or not. The trails are a bit heavier than normal, which is expected in finance, but the fit is still pretty good. So, overall, the model passed all the checks. That means it's ready for testing and forecasting. So now for the forecasting part. First, I trained the model using 2018 to 2024, and I used 2025 as a testing year to see how well the model performs on unseen data. After validating it, I retained the model using 2018 to 2025 and then produced a forecast for the year 2026. Um, in the chart, in my path lab and all the figures that I created. In the chart, you'll see a blue line which shows the historical data, and the dashed line is the forecast going into 2026. A few things stand out there is like the model predicts a slight upward trend going in 2026, and the confidence intervals gets wider as time goes on, which is normal because uncertainty increases the further ahead we look. The forecast is very smooth compared to real stock prices, since ARIMA models cannot predict every retail market shock. So, this gives us an estimate of the unexpected direction of HSY for 2026, but not the exact values day to day. Okay. From the whole analysis, there are a few key takeaways. First, HSY has been a strong performer over the long run, even though the stock had correction in 2023 and 2024. The overall trend from 2018 onwards is still upwards. Second, the returns themselves don't have much predictability. That's why the ACF and PACF for the returns die off really quickly. This supports the idea of, that financial markets are efficient, meaning prices already reflect available information. Third, there's always a risk. The QQ plot and some of the return spikes show that extreme movements happen more often than normal model would expect. This is something investors should be aware of. And finally, the ARIMA model is great for capturing overall trends and producing reasonable forecast. It should never be the only source of decision making, though. Real world events, news, and fundamentals matter too, and we should probably we should not overlook them. Okay, to wrap up this project took the full time series process from starting to finish, exploring all the data, checking stationery, transforming the series, selecting the model, doing diagnostics, evaluating the model on a test year, and forecasting into a future. This model performed well overall, gave a realistic forecast for HSY heading into 2026. So, yeah, I also added my MATLAB script in this presentation just so I have it in here. Yeah, thanks for listening.